Welcome to our webinar today. My name is Nathan George, and I lead our partnership team at GDS Link. And today we're going to talk about what it takes to start a new lending program. Whether you're a fintech startup for the first time launching a product, or maybe a mature lender and launching a new product line that you haven't done before, there's a lot of challenges to launching new loan product into the market. And today we want to cover one specific area to help you do that, and that's how do you make great, intelligent decisions about fraud and credit risk. Joining me to have that conversation is Jonathan. Good to see you.
Nice to meet you, Nathan.
Jonathan's got more than 15 years of experience in the space. He's the, correct me if I get this wrong, Jonathan, the SVP and Consumer Risk Product Leader at Equifax. Jonathan's my go-to smart guy at Equifax for asking detailed questions about new scores and credit insights and whatnot. So really glad you were able to join me today, Jonathan.
Yep, thanks for having me, Nathan.
We're going to do a quick poll here in a moment. Before I pop that up, I do want to let everyone know we would welcome your interaction and questions. Feel free to drop it in the chat. We'll try to address them. If I forget it, one of my colleagues will give me a nudge if I don't see your hand raised, but would love to make this as useful as possible for you. One thing, Jonathan, I wanted to do was to find out a little bit about the audience, who you are and what experience you have. So our first question should be popping up on the screen any moment, and I will give everyone a moment to answer those questions. Jonathan, I'm now thinking maybe I should have thrown some Memorial Day weekend plan questions or answers on there.
I bet you get some really good answers.
Yeah, I know. My mind seems to be wandering towards barbecue at the moment. Maybe that's because I hadn't had lunch yet. All right, I'm going to go ahead and publish the poll results here. Excellent. It looks like we've got 50% for, let me see if I can read it. It's cutting off a little bit. Funded a few loans, and fingers crossed that the default rate will be low. So that's a great one. You know, Jonathan, when you and I first started talking about this, I had asked the question, what are the big challenges facing someone wanting to start a new loan? In your experience, maybe you could answer that. When a brand new lender comes to you and says, what should I be doing? How do you help them?
That's a great question. And I think actually the first question we kind of typically start with is, who's your ideal customer, right? Do you have a strong understanding of who's actually going to be applying for your product? And also part of that, who do you want to give your product to? So I think you'll probably see that thematic, but having a sense from the start is really important. But the other big thing is, all right, when you're starting a lending strategy or lending decision strategy from scratch, is start recording all the data inputs immediately. And it's not because you can do anything with them in the first 30 days. It's really looking later in the journey. You're going to be very happy that you've actually have the ability to record all of your first party data coming in, everything that's stated, as well as all the third party data that you're collecting along the way, which is commonly overlooked. Say, hey, I'll take a look at this later. But no matter what you do, you want to start collecting that data immediately. Also, making sure you set yourself up with flexibility from day one, right? You will be making changes to your decision policy, and you want to make sure that you have set it up in a way that it's easy to change out attributes and variables within that, and that it's not a Herculean effort for you to modify that in the future.
So identifying what your end state looks like is really important to setting it up correctly, what your clients look like, setting it up correctly. When it comes to, you said kind of preparing for the test, or preparing test and building kind of flexibility into the plan of a constant test and learn procedure. what does some of that look like for your clients? Like if you kind of think of the ideal client who did it well,
Yeah.
what did they put in? What did they bake into the front end of that?
Yeah. So normally, especially if you're starting a new portfolio, uh, there's definitely some marketing elements that help you target that right customer. But really, as you get into the decisioning strategy, right, it's one, understanding the fraud footprint, right? Making sure you have the basics of fraud on day one, so that you can either decide how you're going to enhance that or step up, as you go forward. So having the basic, hey, are you who you say you are, and are you a good person? Having that in place, but with the ability to step up into more advanced aspects of fraud as you go through your lending journey, and then as you learn your customer, right? I mentioned collecting all of that data, right? And you're going to make changes to that decision strategy that impact, do I say yes to this person at all? What is my line assignment? You got to know that those are going to change. Those are going to change with macro environment. It also is going to change with just the shape of that portfolio, that you're going to have to be able to tweak those things very easily and ideally on a routine basis, right? So making sure you have the flexibility to either match the macro or the needs of your portfolio, and that you can tweak those levers. And you're probably, as you get more sophisticated, are going to bring in additional data points to even inform those levers. So having the ability to bring in both your first party data and additional third party data on an ongoing basis is really foundational. Because I think Nathan, where you're going to is, hey, laying the groundwork for doing a shadow testing or champion challenger in the future, which is really going to how you're going to really drive your changes in decisioning.
Yeah, I had a good friend that kind of coached me when I first got into the space on, what a good CRO, a credit risk officer, kind of how they plan that out. And one of the things he said was that he had been most successful when he had a constant rotation of testing and already planned before he even starts. That was a really big advantage. Not just for what's next and how to be more competitive and things like that, but also to look for new opportunities that may get surfaced by some of that testing.
100%. And to be frank, it's not necessarily that uncommon where people may not really be starting that until they're 6 months or a year into the journey. And they have lost a lot of kind of first mover advantage or ability to either attain new revenue or reduce risk if they don't start doing that on day one.
Yeah, I would say particularly in fraud, and we're gonna hop over to that topic next, but in particular with fraud, there's certain types of fraud data where age, freshness is really important. So just like you with credit risk data, a lot of times it has to age a bit, so you can see some defaults and make some conclusions based off of that. But fraud is a fast moving, that the elements in a fraud signal are kind of fast moving, and doing a retro test on old data with new fraud signals is kind of tough. So setting that up to run in real time gives you the data that you need to adjust. But before we jump into fraud a little more deeply, I want to pop one more poll up for the audience. I know I was looking at the registration list. We've got a little bit of a mix of attendees in terms of what type of business they're in and things like that. So I want to tap into your experience for the audience and those who are listening. From what you've seen, what is the hardest part of launching a new loan product? So I just popped up the poll there. Would love to get your feedback, and we might focus in on one or two of these areas in the conversation, depending on what you guys are looking at. I'm detecting a pattern already. Let's see. I'm going to go ahead and publish the results here in just a moment. Hopefully you guys can see that. So a little unexpected from my side. Compliance was a bigger one. Jonathan, I'm curious on the compliance front. Have you seen that to be a common topic in with new lenders, new programs that you're rolling out?
Yes and no. I think it really depends on who's getting into the lending business, right? I think it's really easy to start with the assumption of like, I can make all these great data decisions and I can use whatever data I want. And then you very quickly learn is, nope, we've got FCRA data and some of it's adverse actionable, some of it's not. And the intentionality that goes into actually building a credit model is very high. If you've been doing it a few years, you don't even think about it. But if you were trying to build a lending policy from the beginning, well, you should be working with a good partner who's already factored those things for you, would be my recommendation, because it is a bit of a learning curve.
Well, let's hop into the fraud topic. I'm gonna jump ahead just a little bit to highlight one of Equifax products that I think is really interesting, and that's the area of first-party fraud. So we talk about when you get started lending, with a new loan product. Having a solid fraud prevention strategy is really, really important. And there's lots of areas we could talk about. There's lots of great services out there to help with that. One of the interesting new areas for me has been the rise of first-party fraud. So I think you and I had chatted about this, and whether or not first-party fraud check needs to be adverse actionable or FCRA compliant or not. Because the identity with first-party fraud, the identity is not in question. You're getting to intent, and that's a different kind of a thing. Maybe you could talk a little bit about the new credit abuse score that Equifax has, because that's really interesting to me and how you structured that.
Yeah, absolutely. So, as Nathan said, there's a lot of different types of fraud out there, right? And you could have third-party fraud, you could have account takeover, all sorts of things. But there's been a huge growth in really first-party fraud that says, hey, Nathan's the actual person applying, but maybe Nathan doesn't actually have intent to pay me, or maybe he has, bad intentions for, how he's going to acquire this loan, or he's not being honest with me. So I think that's been very pervasive and on the rise. So that's driven a lot of our development here in the past year, and we built what we call the credit abuse score, right? And we very intentionally made that adverse actionable. So you could actually decline an applicant based on that, which is really different than your typical fraud experience, because in your typical fraud experience, you're really just going to increase the friction until the point of dropout, right? Which has a lot of trade-offs, right? You might apply it to the wrong people, and you're going to add a lot of friction to your process as you do it. There's certainly a place for it to be clear. But when we build our first-party fraud or credit abuse score, we said, all right, we're going to actually use this, build this using, FCRA attributes so that you can actually take adverse action. And it's really become an important part of a lot of our customers' fraud strategy, because you're identifying a lot of different behaviors in the score, right? Whether they are likely to have an early payment default or no intent to pay, or some of the behaviors that go with those things, which are on the rise, like credit washing, right? And that's where a consumer really challenges every negative information about them, whether it be true or not, right? And it'll give maybe an artificially inflated credit score, right? So picking out behavior where, hey, this person, regardless, right? We don't think they're likely to pay us. And that's not always an easy thing to sniff out, because it can be common across some actually relatively high credit scores.
Yeah, that's interesting. I think I saw a stat the other day, and if I get the total number wrong, I'm sure one of my friends will tell me. The CFPB saw this massive increase in complaints because people are using AI engines to automatically, question everything in their credit record. I think it was like something crazy, like 600 million requests or challenges, and that's definitely creates some stress in trying to understand, who's intentionally trying to commit fraud and who may have had their identity stolen and that kind of thing. So, or which are legitimate. One of the other interesting facts, and I'm curious as to your opinion on this, when you think about fraud signals, you've got options out there, and like you can go to a single provider and buy every single fraud product. They've got like a layered fraud solution that covers everything from the point of entry onto a online application all the way maybe to a step up to an ID verification where you're taking a selfie and a picture of your ID and things like that. When you think through that, you have the option of buying that one source fits all, or starting to look at, okay, let's layer this and look at each particular fraud component. What have you seen be most successful, especially with a new lender where all of that complexity can be challenging to actually build and execute in a origination flow? How would you advise that they think about that?
Yeah, well, I think there's a lot of providers in that space, and Equifax, to be clear, is an excellent one. But one, they should always understand what are the most common fraud elements of the industry or vertical or customer segment in which they're operating. And the reality is, you are going to have, you might have some providers that really, really focus in an advanced step up capacity, right? And they might be really good at that, but the same ones may not have as robust of a database for device signaling or digital identity trust. So I do think it is actually really important to look at the array of data elements that go into that and what you're actually trying to solve for through each part of the journey, right? I think Equifax is a very compelling solution across that entire journey, but what you often see is a lot of companies that maybe focus in just one part or two parts of that multi-step journey. So I think it's best to make sure you give yourself some flexibility to plan around that.
I imagine too, there's, like when you think about the levers in a fraud decision, you've got your cost, your customer friction, for example, like an IDV step up to scan a driver's license or whatnot. That's asking a lot of an applicant on an online, application. But you also have, actual predictive power to prevent fraud. How, kind of looking at the cost element a little bit, one of the things you had pointed out to me was the difference between pulling all those signals at once versus more of a waterfall strategy with a fraud. Could you maybe talk about a little bit about that? Because that's I think a really helpful way to think through it.
Yeah. So if you think about, just like a credit policy, maybe there's some just really advanced things that you're going to pull only in some scenarios. It also applies to fraud to a degree. So, hey, is this person who they say they are? And there's always some foundational KYC work that you need to do. But ultimately, you're trying to get to a point of confidence that, hey, this is the person that they say they are. And by the way, I think this is a good person. It's really where you're trying to get. And it is kind of incremental information that gets there, right? And there's a lot of stuff that might be a step up. I'm going to pull this more advanced score because this person wasn't at a 10 out of 10 on my first check. But you'll see a lot of in situations, people just pull everything at once instead of taking kind of a stair-stepped approach to fraud. And it really depends on what you're selling and what your lending situation is. But typically, if you can sequence this out a little bit, one, you might be able to reduce the friction for your customer. And two, you're also going to maintain costs throughout that journey, right? You certainly don't necessarily need to go to a full MFA authentication for every single customer on step one, right? And that's going to have undue friction. But maybe you want to pull a synthetic ID score on every single customer. So just being very intentional as to where you think those step ups are, and account for one, the cost, but two, the friction that you're causing your customer through that journey.
Yeah. That's helpful. And kind of taking it back to our starting point of, it's challenging to get a new loan product off the ground because you don't have a lot of outcome data to train things on. I think the fraud portion of that origination flow, curious if you agree, that's one where there's a lot of resources out there. Like you can call Equifax and you guys have a fantastic fraud stack
Yep.
That's trained on real outcome data that can help you figure out the fraud question. Where it starts to get more challenging is the credit risk side. So maybe if we transition a bit to credit risk, and could you talk a little bit about your experience with cold start credit risk? So, when you've got no outcome data to train your credit risk decision and policy and strategy on, what's a good way to think about that, and maybe a good starting point for a new product?
Yeah. So I think that's a great question, right? And you're looking at, hey, I have to solve this lending situation for the first time. So the first thing you have to do is you have to be able to segment your customers, right? And hey, do I understand what customers I want to loan to and not what's the cutoff for this? And then also, do I have a preference for certain types of customers, whether that be a credit segment or other attributes where, hey, this is the best rate. Here's my medium, risk adjusted rate, or the highest rate for the highest risk. Is really from day one, you need to know the answer to those questions, right? And what tools are going to use to segment those customers. So typically, you'll see a lender start off with a generic credit score, and they might just be doing some basic credit cuts. Hey, I'm going to lend to anyone 720 and above, or 680 and above, or I really want 680 to 620. You see some very basic credit segmentation happening. But often, you don't necessarily start with, well, what does the risk of those very different credit segments mean to you? So how are you actually, doing risk-based pricing based off of that data? Is that foundational from day one? And often all this is anchored just on a singular score, right? And that's where we would typically, tell new lenders to focus a lot on what's the first party data that you're collecting, and what is the information or attributes, addition to basic, like just a basic credit score, that you're actually going to use to segment this population. Because I think after you've been in business for long enough, you start to realize the biggest driver of your success is going to be putting those consumers in the right risk buckets, right? And when you understand your customer segment, you can also start to look at, hey, what are the best ways I can capture some of this risk segmentation? And that could be bringing in alternative finance data or telco data. But foundationally, you need to set yourself up to add additional data sources either from the beginning or later, and pay very, very, very close attention as to how you're actually segmenting those risk audiences.
So it sounds like just looking at credit score alone. I mean, I know typically those credit scores can be used to help, securitize your loan portfolio and things like that. There's certainly helpful things you can do with that, but to be not just competitive, but to hit your targets, your KPIs on loss ratio and things like that, you need to go much deeper than that. Well, let me ask this question before I go down that path further. You mentioned being able to put people in buckets, and you mentioned some alt-fi data as an example. So, when I hear alternative data, a lot of different definitions of that. Could you maybe give a quick overview of what alternative data encompasses?
Yeah.
Like, is it just bank data? What is it?
All right. So there's all sorts of different, I think we often say, hey, credit data, which is typically what you'll see on the file. And then you'll see a lot of differentiated data. That is FCRA. So we talk about our alternative finance or specialty finance. That comes from a variety of places. Could be, buy here, pay here type locations. And we also think of our differentiated data as telco data, right? So is a consumer paying their mobile bill, their pay TV bill, their gas, water, electric bill? Those things are not actually on, the standard credit report that goes through another CRA. And when you look at probably some of the most successful financial institutions, they're pulling these types of data, from Equifax or another provider, bringing in those attributes to give a kind of a next level segmentation of those risk audiences. So, we start foundationally with traditional credit data, but we will start bringing in these other data assets, which, kind of to your earlier point around compliance, also have to be FCRA compliant And it's just going to give you a more dimensional view of that, of that consumer, especially if they don't have a particularly thick file, knowing whether, if they had if they did not pay their power bill or did not pay their mobile bill 6 times over the last year, is incredibly predictive. Also, if they might have a thinner file, right? And this goes a lot against what's the audience you're trying to capture, but they've made 12 months of utility payments on time in full. That's really powerful information that you want to know.
So, philosophical question. You hear sometimes cash flow data in particular being termed as the ability to pay, and credit history is like the willingness to pay. I kind of like that. That's a nice little buckets to put those things in. But it seems like alternative data is a little of both. Like you've got some ability to pay signals with the example you just mentioned, paying your rent, paying your utilities, whatnot. But what about how would you categorize alternative data? Do you think it's just that ability to pay, or do you think there's, or willingness to pay? Like, where's the strength of that signal? Is it across both buckets?
If I had to choose one, I would actually choose willingness to pay, right? Because you get a better view into a consumer that, hey, there's always kind of like a Maslow's hierarchy of payments, right? Is that they're going to pay either someone has an intent to pay nothing, which then you're really looking at a first party fraud, or they have to make, prioritize choices to what they're going to pay. So if I chose one, I would usually index on willingness to pay. You're getting a view of their total payment behavior. There's only so many people in the world who just decide not to pay anything. And especially when you look at, certainly utility data, these are things that people have to really operate a normal human life a lot of the time.
Got it. Yeah, and I like or at least the way I hear most of the time people thinking about it is, lenders thinking about it is, this lets me say yes to more people that I might not have been able to use traditional credit data alone to score. This allows me to kind of increase the size of my addressable market.
Yeah. So let's talk about usually when you bring that data in. I think that's a really important point. It is usually focused on saying yes to more, right? And I think that's actually the goal of most lenders, is that they actually want to give more loans with a relative level of confidence. And if there's folks on this call that really are, especially looking at fintech or unsecured, you're going to often see thinner files, right? Where they may not have as many years of credit history on the credit report as you want. Or they've only had 2 credit cards or 0 credit cards. When you go into these other data sources, right, you are getting a much better view, especially of those thinner files. In fact, that is often where it is the most powerful is, hey, Nathan has a 660 credit score, but because I've seen his payment behavior in other places and it's really positive, I should be really confident in offering him this product. Those are the type of scenarios that you're going to create. And those are often some of the best consumers that you want to capture.
So I'm curious, I'm thinking about the saying yes to more and putting yourself in the best position to make an intelligent judgment about which bucket you're putting that applicant into, which risk bucket you're putting them into. Some of the other products or services or questions I've seen is like, what about trended data? Right? Like most people are just pulling a score, which is a snapshot in time. Although some new scores include trended data. Could you maybe talk about that and provide some guidance for people who of which to use where?
Yeah, so absolutely. So I don't think people really ever regret using trended data, right? I think it's a better predictor of behavior. You definitely see, VantageScore brought trended data in. We bring trended data into really all of our advanced scores, and you're going to see that commonly used. Really, you'll see it every time, pretty much when a mortgage is pulled or a high dollar, asset is in play. People are going to use trended data. I think it's just generally more predictive, and if you can incorporate into your decision strategy from day one, you absolutely should.
I'm curious because that you mentioned you've never heard anybody regret using trended data. I'm curious if it helped or hurt or was indifferent, no difference, when big swings or big changes in behaviors like COVID or gas prices going above $4 on average or something like that. Have you seen trended data be more or less or the same in terms of predictive power?
Yeah. So I think, and I've got a whole team of people that would answer this better than me, but in terms of when you look at a behavior over time, right, that is where trended data, I think, becomes the most powerful. So I think it is really important to use when you kind of are looking at this, the economy. I think people decide how they think about it or how they feel about it on a daily basis. You're getting a longer view. You're getting a trended view of that consumer over time. So you have a better stance of how they are going to perform when there is maybe any kind of macroeconomic schism or anything like that. So I think what higher uncertainty, I think the more powerful that data would be.
Helpful. So let's shift gears a little bit towards what ought a new lender or someone who's offering a new loan product that they maybe don't have a lot of outcome data to train against, things like that. What does that journey look like for the first 90 days, the first 100, 90 to 180, 6 to 12? Like what are some of the things that they should be doing? I think particularly in those first 90 days when you're kind of testing and seeing what the outcome's going to be. You're not seeing defaults come in yet. Like what does that look like first 90 days versus, let's say, 90 to 180?
So let's talk about the first, let's talk about the first 90 days. To me, the first 90 days are the most terrifying because you actually have no defaults. And often that kind of goes to one, select an amazing partner to start this journey with, so that you have just a sound credit policy to start with. But at 90 days, this is where you're going to start maybe seeing some of your fraud intel come back, and is where your maybe no intent or early payment default has happened or is happening. And it's really so much as the data collection focus the first 90 days. You had to put some very sane guardrails in place. Typically, you're going to err on the side of conservatism because you don't want to go out of business in the first 90 days. And this is going to be your first miniature view of performance. And I think part of it is you have to be in this data collection phase. And it's only really your first 90 days if you've been collecting all of the data. Right. And this is where you're going to take your first look. And we usually tell people to not overreact and go crazy with changing their entire policy. You need to really look at the data and look at, where you might want to apply a little friction, but not too much, really, so that you can have a very productive 180 days. But Nathan, I bet you might have a little perspective on that as well. And you get to see a lot of these policies take course as well.
Yeah, well, I mean, for us, the first 90 days, like you said, they're a bit of a nail biter. I think what we look for, as you said, is fraud. Like we have good averages of what it ought to look like in a mature program, but the other variable in those first 90 or even 100 up to 180 days, the other variable you see is how many people are making it through the door to a funded loan, right? Like that seems to be a pretty good indicator. I'm curious though. Well, one other note, shameless plug for our platform. I mean, we work hard at putting the important indicators on a dashboard that's human readable for people to watch in real time during those first critical months, so that they can see across both the fraud risk and the credit risk how their strategy, how their decision logic is working for them. And it's especially important to match those up or align those with your KPIs before you push the go button, so that you're able to see what, like having the right tooling is really vital. Throwing things together without thinking through that is really tough.
Yeah, I think probably the one of the biggest things that you actually have at those first 90 days is where people are most commonly going to touch their line assignment, right? Did my target consumer actually take the offer, right? And I think that's usually where you're going to see the most tweaking is, hey, this person looked like they were a great credit applicant. Did we extend them offer? Did they take it, right? I think that's where you're going to see the most focus. And then as you get to that 180 days, it is a different ballgame because you're actually going to have your not only, hey, did they take the offer? You're going to have your first view of really strong view of performance data. And you're going to say, oh man, well, these loans are performing great, but these other loans really are not performing great. How exactly did I get myself in this situation? And how do I course correct out of here?
Yeah. I imagine your distribution across the buckets that you picked, like that you're targeting, your distribution across those buckets is definitely going to be an important one to take a look at.
Yes, 100%. And, there's also a lot of kind of APR tuning that goes into that because, getting the right customer with the right offer for sure.
Let's shift gears. We've got about 10 minutes, a little less than 10 minutes left to go. Let's shift into what separates successful lenders from successful startups and things. I think we've talked about a few. One of them was planning for a continuous feedback loop from day one. That's an important one. What are some of the other things that stand out to you as successful lenders have adopted best practices for successful starts?
So I'm going to start with that feedback loop actually as number one, right? Mm-hmm. We're recording all of our data, right? And we're constantly testing different policies in the background, right? I think if there was like number one standout is someone who's actually constantly looking at their decision policy and adapting to change in it, right? The second one I would say is, hey, you're looking at the decisioning and the analytics that come out of it, and you're really picking, where to focus, and you're really focused on that credit segmentation and where to bring in additional data points or to modify that decision strategy. But you can really only do that when you have either the shadow testing capabilities running the back end, or you have a robust champion challenger. It's not the person who's waiting a year to revisit these things. It's the proactive view. How are we changing to the macroeconomic environment? How are we changing to our past performance? And what data are we using to drive those decisions, right? And obviously, there's a little bit of an art and a moderation to making those types of decisions. But so much of this comes down is, did you set yourself up for success on day one? Which means you're collecting all the data and you're learning from it throughout the journey.
Yeah, I think, that's one of the reasons GDS exists as an organization, is to not just execute on smart origination, fraud and credit strategy, but to have that feedback loop so that you've got all the data at your fingertips you need to make wise decisions that put you on target versus, hey, there's lots of options out there for let's get a quick start going. Let's get started quickly. Let's throw up a online application form and things like that, but they haven't put those other things in place where they're doing that champion challenger testing of maybe small tweaks to their strategy or to line assignment or whatever it is that they're wanting to look at.
Yeah, I think is actually having a really strong partner from the start who, one, understands the space in which you're operating, whether that be card loans, personal loans, you name it, right? That they actually understand that journey. So you have this amazing framework from the start. But it's also, if you look at the largest, most successful banks in the world, they're bringing in thousands of attributes, and I mean thousands, plural. How can you start to consume some of that best-in-class data assets in a way that's going to allow you to and really advance your decisioning strategy to get to comparable levels, knowing that you don't have 600 data scientists, right, on your team reviewing every single part every day. So how can you consume some of the best in class data assets, right, comparable to what the largest institutions use, and put that into your policy, right? Put that into your decisioning strategy.
Yeah, I little bit of a commercial plug for one of the things we're doing with a product we're calling Quick Start, and it's why we partnered with Equifax. Is we've got a package now that is meant to help with that particular problem. So it's got the fraud solution pre-built. It's got a credit framework using the best-in-class data you mentioned and those best-in-class insights, which I think really help with that cold start credit risk, using more than just a credit score, some of the latest and greatest from the Equifax lineup, pre-built and ready to go on day one. I think one of the coolest things about that new project, which we're excited to be working with you guys with Ignite integration and things like that, is what kind of AI insights can we derive? What kind of simulation and optimization? We have another partner that we work with, Stratify, where we're doing optimization process for Quick Start. So for you get enough data in house, sufficient size and time length, you can actually optimize that credit strategy automatically right out of the platform, which I'm excited to see the results with the first few clients. Yeah. I did have a question pop up in the thing. I wanted to give you a chance to answer it, and we're moving into Q&A. We got a few minutes left. The question is, we've got a near prime, maybe subprime client asking, if you had to pick, Jonathan, of the one or two Equifax data assets to add that would be the most impactful to test, what would the one or two be that off the top of your head?
Yeah, so that's a great question. So we really pivot for that question. We actually go to our VantageScore for consumer product, right, which brings in those alternative finance as well as utility data to that customer, right? And that is where we have a massive analytical lift of that segmentation, especially if they're either subprime or near prime or approaching that prime, is getting them in that right bucket with a very high degree of confidence, right? And that's where we go to our VantageScore product for that pretty much every time. And you've got the specialty finance data in there as well as telco data feeding that. And it's a game changer. We have a number of customers use that, and it's probably one of the highest and best use cases, is really separating those audiences with a lot of confidence, right? And a lot of times it is going back to that storyline of saying yes to more. Yeah, this person, you do want to make that offer because these other things.
That's helpful. One more, I guess I'll take this one, is what's the timeline on the Quick Start tool that I mentioned? What's the timeline for launch? Our goal with Quick Start is to be up and running in weeks, not in months. Best case scenario, we're at 2 weeks, but remember, there's often data contracting and compliance and credentialing and legal and compliance hoops you have to jump through, which was, if I recall back to our poll, that was like the longest poll in the tent, was the compliance aspect.
If it was just as easy as making a decision, it would go much faster. I think we start and we end with compliance on that front, Nathan.
Yeah. It's funny, the technology stuff that you can pre-build so much of this and have everything ready for the tweaks and configurations that are kind of self-service and really easy to do on your own. But that compliance, the legal and compliance checks are always the ones that you got to plan for ahead of time as much as possible. Well, with that, Jonathan, thanks very much for the time. Good conversation. I'm looking forward to maybe doing a follow-up in the future to talk about Quick Start and testing some of the things we've been recommending and maybe having some real case studies to show.
I'm really excited to see when you start a business with really this foundational, or a lending strategy with this foundational plan from the start, and you overlay that really with some of the best in class data assets at the ramp up and velocity at which people are going to be able to really build awesome credit strategies. I'm really excited to see that.
Great. Thanks. Us too. We'll be publishing, I think, some things online. We may do another webinar about that. Thank you, everyone, for joining. I threw up our final slide. You've got our email contact here, or you can hit us up on the website. I'm happy to answer any questions about any of the products or topics we've discussed. So thanks again, everyone. Hope you have a fantastic Memorial Day weekend.